$16.3 trillion. That's how much money tracks the S&P 500 index. And Flex just got handed the golden ticket to join it. This isn't just corporate news. This is a financial event that will force billions of dollars to move, whether fund managers want it to or not. By the end of this video, you'll understand exactly why S&P 500 additions create massive money flows, what the historical data says about stocks that get added, and whether this Flex news is an opportunity or a trap for your portfolio. Let's get into it. First, who is Flex and why should you care? Flex Ltd is a Singapore-based electronics manufacturing giant. They build components for companies you definitely know: medical devices, automotive parts, cloud infrastructure, consumer electronics. Revenue last year, over $26 billion. This isn't some speculative tech startup. This is a profitable, established company that flies under most retail investors' radar. They're replacing Celanese Corporation in the index, effective before market open on March 24th. Mark that date. Here's where it gets interesting. When a stock joins the S&P 500, something mechanical happens. Every single index fund, every ETF tracking the S&P 500, every target date retirement fund, they all have to buy shares of Flex. Not because they want to, because they have to. Their mandate requires them to mirror the index. We're talking about an estimated 40 to 60 million shares that need to be purchased in a compressed window. Think about that. Forced buying, no analysis, no valuation models, just pure mechanical demand. Stop and consider what this means for price discovery. This is why the S&P 500 addition effect exists. Academic research from multiple studies shows that stocks added to the index experience abnormal returns around the announcement and effective dates. One study from the Journal of Finance found average abnormal returns of 3 to 5% between announcement and inclusion. Another found even larger effects during high-volume additions. But here's the pattern interrupt you need to hear. These gains often partially reverse in the weeks following inclusion. The smart money front-runs the announcement, the index funds pile in at inclusion, and then the artificial demand disappears. The stock has to stand on its own fundamentals again. So what does the data actually show? I pulled the numbers on recent S&P 500 additions. The pattern is remarkably consistent. Stocks pop on announcement, usually 3 to 7% within days. They continue climbing into the effective date as index funds position. Then reality sets in. Roughly 40% of additions give back at least half their inclusion gains within 60 days. This isn't speculation. This is documented market behavior. The question isn't whether forced buying happens. It's whether you're positioned to benefit from it or become the exit liquidity. Now here's what this means for your portfolio specifically. If you hold broad index funds, and statistically you probably do, you're about to own Flex whether you chose it or not. Your fund will buy at whatever price the market demands during inclusion. You have no say. This is the hidden cost of passive investing that nobody talks about. You're always buying high during additions and selling low during deletions. It's baked into the system. Does this mean passive investing is bad? No. The data still favors low-cost index funds over active management for most investors over long time horizons. But you should understand the mechanics. You should know that every S&P 500 change costs you a tiny slice of returns through this forced trading. For active investors watching Flex specifically, the risk-reward here is asymmetric and not necessarily in your favor. The announcement pop already happened. The easy money left the building. What remains is a company trading at around 15 times earnings with solid but not spectacular growth prospects. If you believe in the manufacturing renaissance narrative, if you think nearshoring and supply chain diversification will accelerate, Flex could be a legitimate long-term hold. But buying now specifically because of the S&P inclusion? That's buying the news after it's priced in. Here's the bottom line. The S&P 500 edition of Flex is a masterclass in how index mechanics move markets. Billions will flow, prices will adjust, and most investors will never think twice about it. But you're not most investors. You now understand the forced buying phenomenon. You know the historical patterns. You can make informed decisions instead of being pushed around by mechanical flows. That edge, that awareness, compounds over a lifetime of investing. If this breakdown helped you see the market more clearly, subscribe and hit the notification bell. I release videos like this every week. No fluff, no filler, just the financial mechanics that actually matter. I'll see you in the next one.